We should have matched our size a little better, our height. But thanks, Rusty. Well, good morning, everyone. Pretty good crowd for a 9 a.m. accounting presentation. We don't usually get a lot of interest in this stuff this early in the morning, but we'll try to get you guys. We're not going to get back on time, but we'll try to not get too much further behind. So we titled our presentation "Leveraging the Good Times," which is we're all pretty familiar with the market and where we're at right now, and we're going to try to talk about how we can protect that and just a few things to make sure that we're taking advantage of the good times we're in right now. So our agenda is a little bit of business arrangement and business structures. Roxanne's going to talk about maximizing tax and purchasing land, and then we're going to just talk about how we protect what we have now. So we'll skip our introductions since Rusty did a much better job than I could do anyway. You're probably all familiar with MNP. We are probably the biggest and definitely the first accounting firm to really specialize in agriculture. Fifth biggest in Canada now, and yeah, we've got a giant presence in agriculture, so happy to be here with you guys. So we'll jump right into business arrangements. When we talk about structure, we really want to separate estate from business. We're trying to set up a structure that works for the business. The estate is a separate piece, so we want to make sure we can separate those. It is hard to do because oftentimes they're very, very linked, and we don't want to necessarily unlink them, but we do want to clarify. And so business structure and farm structure matters because businesses with good farm structures and that are set up properly will have incentives and goal congruence that leads to increased profitability. We can help mitigate family disputes, which I'm sure everyone in the room has heard a story about a farm business that's failed. And lots of times if you peel back the layers, it's, I don't know where my equity is or what I own or whose job it was for this, and we just decided to call it quits. And then on the positive side of that, transitioning farm and family management. So succession planning is a hot term, but really how do we get the responsibilities transferred to the person that needs to be responsible for them? And then at some point in your career, transferring and converting physical assets into cash. Tax comes to mind when you think of that, but business structure is important to get those assets converted to cash and put them in the right spot. So indications of a poor farm structure, there's lots of them. There's a few up here, and I won't go into too much detail on them, but a couple of the main ones would be machinery purchases. We see duplication of machinery all the time. You could have two combines in the same yard when really one would suffice, but we don't know who's combining which crops from year to year, so we need two. Things like that. Non-profitable buying decisions. So machinery's maybe now is not as depreciable as it has been the last 30 years, but it's not a good investment. And then timing of production. So greedy or stupid is a term we like to use. It's maybe a little bit of an eye catcher, but if you've got a yard full of purebred yearling bulls that are for sale, and some of them are mine, and some of them are Roxanne's, and we share the same yard and we feed them together, but we're not one business. If Tyson wants to come buy a bull from me, I'm the only one there. I've either got to be greedy and sell him one of mine or stupid and sell him one of Roxanne's. There's no real goal congruence for selling the best quality product in that operation. And wasted effort and management skills. I'm not very good at organizing stuff, so I try not to do that very much. But we have lots of people in our office that are good at that. And so they do a really good job of the organizing. I can come and drink beer at the cocktail hour here, and I like doing that. So we like to specialize in our certain areas. It should be no different with farming. We should do what we're good at and what we enjoy and find someone to do the things that we're not good at and don't enjoy. Which really, I don't know if you guys can read that orange font at the bottom. It's kind of maybe a poor choice of color, but lack of goal congruence is the number one indicator of a poor farm structure. So some examples of that, which we've all lived. Cumbersome administration, who pays what bill? We don't want to be at the counter at the parts store trying to remember who paid the last repair bill on the baler and who's going to pay for the sprayer repairs next month. we shouldn't spend time on those sort of decisions. And then that leads into who owes who for what, we're all accountants, and it's hard enough for us to keep track of that stuff, so I can't imagine doing it day to day. Whose loan is that? I have a client right now that's in that situation where they put everything into one bank account, and then it's like, who gets the money first, because there's lots of loans that need to be paid, and they're not all in the same spot. So spending time like that, it's not a good use of our time. And again, lack of goal congruence. We want to have everyone on the farm and everyone in the business pulling in the same direction for the best use of their resources and for the common good of the farm, not necessarily for the common good of one individual person. Okay, so we'll do, this is actually a little bit of an example for you guys to work on this morning. So we've got two farmers here, a father and a daughter. Dad's 62 years old, owns 2 sections of pasture, and has $1 million of cash. And the daughter is 28 years old. She has 2 quarters of pasture and $80,000 of cash. They need $2 million of capital to set up a new ranch. The daughter's going to be the main operator, so she's the day-to-day boots on the ground boss. We don't care about tax, and we want to not think about estate. We're just trying to structure this business. So starting a new ranch, dad's got most of the equity, daughter's got most of the management and labor. Just take 1 minute or 2 minutes at your table and talk to each other how you would structure this type of a business. And you have to actually talk, because I'm not going to talk and it's going to be awkward. Tyson's going to be here. If you have a question or you want some guidance, he can come to your table. Okay, I think we're going to get going again. Now that everybody's had a chance to get to know each other at their table and discuss the weather, hopefully somebody at least talked about the farm structure question. Tyson made his way around. There was a few questions for him, which is good. So Tyson, do you want to just tell us maybe what you heard from around the room, or maybe what you didn't hear?
Hopefully everybody can hear me here. But there was a lot of good conversations. Some of you were talking about other things more important than this, and that's great. But for the ones who are talking about this, really good ideas as far as getting some prenups, using land for some equity leverage, and even going, okay, do we do a corporation? Do we do a partnership? All those kinds of things. So lots of good, really good discussions. What I didn't hear was, well, the daughter will go out and she'll buy a tractor, and then dad's going to go out and he's going to go buy all the manure spreader, and he's going to build the buildings, and we're going to go halvesies on some of the computer stuff. I didn't hear any of that from any of the tables. Maybe I missed it, but all the tables were talking about the good farm structure. So it was great discussions.
So thanks, Tyson. So really, everyone in the room has already figured out the answer of the main question, which is, are we one business or are we 2 businesses coming together and operating as 2 businesses? And so the details of how we get there, there's no right or wrong answer. Could be a corporation, could be a partnership, could be 50-50, could be 90-10 with land rent. There's so many different combinations, and there's no right or wrong answer. But the main thing, like Tyson said, is we wouldn't set up a brand new business by having Tyson buy the chairs in the office and me buy the computers and Roxanne pay for the coffee maker. So why do we do that on our farms? And really, to summarize, if we operate as one business, we should negotiate how we split our profits from year to year. We should communicate operational duties and who's going to do what. And if we're one business in operations, let's just be one business. Let's cut out all the administrative pain of arguing over who pays what bill. So I'm going to skip through these ones just in the interest of time. We've got a few common business structures that we use very often, but if you guys have questions about a specific structure, just come and grab one of us. We'll be around for the rest of the day.
Awesome. So another important thing to talk about is your wills. So I was thinking to myself while we were preparing for this presentation, if you take nothing away from this presentation this morning other than thinking, if you're thinking I need a will, yes, definitely recommend. Or maybe you're thinking, It's been a few years since I've updated my will. There's been a lot of positive change, in the last decade or so. So really just want to reiterate, if you need to update your will, add that to your to-do list as a takeaway after today. But it is important to distinguish the difference between what's in a will versus having really strong business agreements. And so like Logan and Tyson were talking about, lots of things to consider with good business structure. What comes with that is strong business agreements. So working with your lawyers and your professionals to get those in place. And we have a few things highlighted on here, things that we see commonly with our clients that we recommend or implement. So you'll see some that are more in the line of talking about land, so the right of first refusal. So real simple example, mom and dad own the land, farming kids are renting that to farm. You can put a right of first refusal in place, some legal agreements, so that if there does end up being a dust up and mom and dad say, I'm going down the road and I'm selling the land to the neighbors, they actually can't do that legally. They have to offer the land first to the children in that situation. So something like that is what we'll commonly see, or the option to purchase. So same example, mom and dad own the land and are renting it out to the farming children, and they have that option to purchase it, whether it's over the term of the agreement or at the end of the rental agreement. Long-term rental agreements, that's a common one too. So we always say with these things, you hope you don't need to necessarily use these agreements in some circumstances, but we're always planning for the 5 Ds, as we call it: death, disability, divorce, disagreement. Do you know the 5th one? Yeah, I was thinking about this on the way. I was like, ugh. Okay, so the 4 Ds, but for sure one of them is going to happen to everybody in the room, and that's death. The other ones we hope don't happen, but we need to plan for those, right? So that's just part of the whole reason we need to make sure we have strong wills, but then also written business agreements. So we also have on there partnership agreements. We were talking about partnerships as a structure. Partnership agreements, or if you're incorporated, having that USA or unanimous shareholders agreement, it just has those kinds of things of how do we deal when one of those 5 Ds, disability, divorce, death, disagreement, which we all hope it doesn't happen, especially if you're in a family farming operation, but unfortunately we do see in practice that it does happen, so it's important to make sure that you've got strong legal agreements. So another thing with wills, another thing with wills we'll chat on, everyone's got their different opinions on how assets should be distributed in a will. If you're leaving things to your children, we're pretty firm believers at MMP in percentage split, and I'll kind of walk you through a quick exercise as to why. But before we look at that, if you think of it in an extreme example, we always like to use examples like that. 15 years ago, let's say you had a portfolio of BlackBerry stock and you had a portfolio of Apple stock. And you said, I'm going to leave my BlackBerry portfolio to one child and I'm going to leave my Apple stock to another child. Sounds great at the time, lots of value in both. Fast forward 15 years, well, things look a lot different now. BlackBerry I don't think is worth a whole lot, and Apple is definitely growing in market share, right? So extreme example, but it kind of gets you thinking when you're doing specific assets in your will. If you're intending for an equal split amongst your children, it can change in a hurry just with the way values on certain assets change over time. So the example on the screen, we're talking about 2 daughters and what's being left in the will for them. So in this example, one daughter's getting 2/4 of land and the other daughter's getting the cabin, RRSPs, and cash, which is all fine and great if you're saying that's as of today and it's a pretty equal value, about $1.2 million each. But fast forward 10 years, land's likely going to appreciate in value. How much? Who knows? Cabin may have appreciated a little bit, but maybe you were spending those RRSPs to live on in retirement. Cash balances may change. All of a sudden, if you look on the screen there on the right, we see an imbalance, even though the intention was equal distribution of the estate, right? So again, that's why we really preach on that percentage distribution. So even if you're leaving specific assets to specific children, there's some sort of clause in the will there, some kind of even up, if you will, just to make sure that there's that equal distribution, if that's your intention, right? So just touching on that real quick. Don't know if I missed anything there, Logan. Okay, the exciting stuff. So yeah, you're all looking at that going, maximizing tax. This lady's crazy. You think it should be saying minimizing tax, but if you're paying tax, we usually say it's a good thing. It means you're profitable and you're making money. And our goal with our clients is to pay the most amount of tax at the most efficient rates to help you grow your wealth, help you grow your business, right? So we'll talk a few things tax, because you can't have accountants up here without talking about tax. Yeah, oh, you're on it. Thank you. So, yeah, two really important things to talk about for the farming industry. Some of you may be familiar. I'll try my best to get through them in decent time. But there's the concept of intergenerational gifting of farm property and your lifetime capital gains exemption. Two super important planning tools that we use with our farming clients. The farming and fishing industries are the only industries in all of Canada in the Income Tax Act with the Canada Revenue Agency that allows for these. So what does that mean? Qualified farm property, so that's farm land if you own that personally, shares in a family farm corporation, or an interest in a family farm partnership, provided they qualify, which I'll get to in a second. Those can be intergenerationally passed down from one generation to the next with no tax triggered, whether you gift that during your lifetime or in your estate. The value of that goes to the next generation with no tax. So no other industry gets that. If you think of it as an example, I think on the slide there it's talking about a quarter of land. Dad passes that to children in the estate. There's no tax triggering on that. If he owned a commercial apartment building in Regina and is worth $1 million on his passing, there would be a 25% estate tax on that. So any other industry, again, other than farming or fishing, there's going to be that estate tax, but if you plan properly in farming, you can do that intergenerational transfer with no tax triggering. So it's a huge planning opportunity, but there are some important rules and things that you have to apply, and it can get complicated in a hurry, unfortunately, but that's why I guess there's nerds like us to help you out with that. So then we just talk on the next slide here about corporations, so same idea as the example on the last slide with farmland. If you're incorporated and you have shares in a family farm corporation, or if you're in a farm partnership and you have partnership interests or units in a farm partnership, again, if they qualify, those can transfer to the next generation, no tax being triggered, either on your passing or if you gift that in advance of your passing. However, we really need to watch, and so we call this keeping the farm corps pure or purification, because if you've got other things going on there that aren't actively used in the business of farming, so let's say you got some GICs piling up in your company, just stockpiling a little nest egg there, or you got an investment portfolio, or you've got some commercial property that's, gravel business, that's a good one, something that's just not actively farming operations, that can taint that corporation and throw it what we call offside, meaning then you're just as the same example as owning the commercial apartment building in Regina. You're going to trigger estate tax on the shares that you own in that corporation on your passing. So we really have to watch, and so what we do then in that instance is we have to do an analysis. And so without getting too into the weeds, there's a sample farm up here, but it's just taking the balance sheet. So what the rules are with CRA is you got to say at least 90% or more of the fair value of the assets in that farm corporation or in that farm partnership are principally used in the active farming. So they have to be active farming assets. So we go line by line, we identify what all the assets are in that corporation or in that partnership. We say whether or not they're active or inactive. So in this example, there's a little bit of cash, there's some grain inventory, some investments, 3/4 of land. So land isn't automatically active, because if you've been passively renting that for more years than you've been farming it, it may be considered a passive inactive asset. So if you're thinking, geez, I got a lot of farmland, but I've been renting it out for a number of years, or whatever the circumstances are, you have to watch, because that can taint the qualification. And then there's some capital assets, machinery, equipment, infrastructure, that kind of thing. So you can see we've split it out. In this particular example, active assets were about 2.2 million. Inactive assets, about 755,000. Well, if you look at the bottom there, 14% of those assets are inactive or not used principally in the active farming. So this company is what we would consider offside, bad, because that's going to trigger an estate tax if you don't plan accordingly. So what we'd want to do is purify that. There's ways you can do that. You can create holding companies. There's planning options you can do. We want to get those active farm assets to at least 90% or greater. So super, super important. Again, if you're sitting there going, ooh, I got a big investment portfolio, or I got some GICs, or I've got some passive land, gravel company, commercial, whatever, good idea to come chat with us or to look into that. I guess I want to just jump back. I did want to touch quickly on the lifetime capital gains exemption. So I've been talking a lot about that intergenerational gifting, right? So you can either do that during your lifetime or on passing. If it's qualified, no tax is triggered, we're all good. Super important planning tool. Make sure you're you're looking into that and utilizing that. The other thing is a lifetime capital gains exemption. So everybody in the room has it. It's $1.25 million for each individual taxpayer. And some of us may use it, some of us may not in our lifetimes, but everyone has access to it. And what it means is if there's a capital gains triggered on qualified farm property, so again, we're going back to farmland, shares in a farm corporation, interest in a farm partnership. If you trigger a gain on that, whether you're selling it or even on transfer, you can trigger a gain to get the cost base, we call it up. You can utilize that 1.25 million and basically shield the capital gain, which would save you a lot of tax. Otherwise, you'd be paying capital gains tax, 25% of your capital gain, give or take. So it's another huge planning opportunity. There's other ways we can use it. If maybe some of you have been through the path of having a farm partnership and incorporating your interest, it creates an opportunity for you to pull money out of a corporation and not have to pay any personal tax. Big planning opportunities there. Just because of time, I won't jump too much into it, but if you have more questions on that, that would be the other second super important planning thing available to the farming industry that we do with all of our clients.
On capital gains, but the lifetime or the intergenerational rollover has no cap. So if you have $50 million of farmland and it all qualifies, that can all transfer to the next generation with no tax. Whereas the capital gains exemption is 1.25 million per person, and that's a cap.
All right, real quick here, just to kind of demystify maybe the misconception. A lot of people say, well, when you incorporate, it's cheaper tax. You only pay 10% tax. Not necessarily true. There's always a layer of tax if we use a simple example, if you're a small business and you have $500,000 of taxable income, you'll pay corporate tax at 10%, versus if you earn that full $500,000 personally, the top personal tax rate is about 47.5%. So in that example, yes, it's an extreme difference in tax rates, but if you take any of the after corporate tax dollars out of the company, you will trigger, unless we do the planning like we talked about, personal tax, and the all-in rate actually ends up being pretty much the same. So if you have a corporation, you make 500 grand, you pay 50 grand in tax at 10%, but you pull the whole lot of it out personally, you're no better off than if you were just earning that income personally. Where the real power of a corporation comes in is the deferral of tax. And so you pay that 10% layer of tax. So in that $500,000 example, $50,000 tax, you got $450,000 left. Take a little bit out to live on, but you got a lot left back in there to pay down debt, to grow your business. That's where the power of deferral and the use of a corporation comes in. That's probably all I'll touch on that side. So real quick, purchasing land, we get this question all the time. We've got a lot of strong opinions on it. Should I buy this personally? Should I buy this in a corporation? There's pros and cons. Just with the price of land today, the cost of borrowing, we do advise a lot of our clients to buy it in a corporation, which you're thinking, whoa, never heard that before, but I'm going to walk you through the math on that and why it makes sense. But for sure, there's some drawbacks to buying corporate land, don't get me wrong. It's a little more restrictive, right? So if you've got individual personally held land, you've got a lot more flexibility, right? As far as who you want to gift it to, if it's to certain children, if you want to sell some, keep the others, you can access that lifetime capital gains exemption we talked about if you want to sell it. Also having land trapped in a corporation, if you retire and then you're passively renting it out, can lead to some tax implications, some passive tax in a corporation that we've got to plan around. So there's definitely more planning, and like I said, the biggest thing would be less flexibility. However, the main benefit is that you can buy more of it and you can service your debt a lot faster. So just going back to that example, 500 grand in the corporation, 500 grand personal, you only got that 10% layer of tax. If you keep it in the corporation, well, if your land and your debt are in the corporation, if you say you got $450,000 of after corporate tax profits, you can use that to pay down that debt in the corporation, versus if you own the land personally, now you got to suck that cash out personal, pay a personal layer of tax, and then go make your debt payments. So you're left with a lot less cash to pay down the debt. So in this example here, it's buying quarter land, similar idea, but if you just look there at the difference, so there's that 30% tax difference, right? If you're keeping that those profits in the company, it would take you about 1.67 less years in this example to pay down that quarter of land if you did it through the corporation versus personally. So pretty strong. If you look At the next slide, if you're looking at it as far as 600-pound steer calves, those are corporately owned. You have to sell 111 less calves, again 30% tax savings. Or if you're in purebred and you have yearling bulls, 61 less yearlings, again 30% tax savings. So it's just to illustrate again the power of corporate tax dollars and being able to make you money, reinvest in your business, pay down your debt a lot faster than having to take it out of the corporation, pay that personal level of tax. It just takes a longer time. So if you've got questions on that, or you want to walk through some scenarios, come find us afterwards.
I get a few more. Okay. Yeah, it's a tough crowd. Okay, so how do we protect what we've built now? We've seen land values increase many times over in the last 15 or so years. We've seen cattle prices at all-time highs, so breeding herd and inventory are also at all-time highs. We've come a long ways, but we don't want to go backwards. And so a couple, I guess, key points. We've seen really low interest rates through the COVID period, and then they went to, in my lifetime, really high, which to most in the room, it's not that high, 8%. But now they've come back down to a point where we're looking at refinancing some of those purchases where we maybe had a 6.5 or 7.5 or 8% loan, and now we can get 4% maybe, or maybe Garrett can get you even less than that. I don't know, but some of those purchases, we can just use that equity that we've built up now and maybe consolidate some of that debt, maybe get a better interest rate, and maybe get a little bit better payment terms so it's a little more flexible on our cash flow. So just leverage that strong financial position we have today. Less interest costs and less frequent payments help us to service our debt better with lower debt servicing costs. And then having simplified loans. So for us as accountants, it's so much nicer when there's 1 or 2 loans instead of 15 different small loans. So just simplifying things, kind of keeping on top of what has to be paid when still, but just having 1 or 2 partners instead of 10 or 12. Agri-stability. This is actually the title of our presentation and the agenda, but we veered off a little because we thought there'd be some different stuff to talk about. But it's very timely. The deadline to enroll has been extended to July 31st this year. So you can kind of wait until the house is on fire to buy the insurance to protect the house. So it's very good if you are maybe not enrolled in the program and you're thinking about it. You've still got time for the 2025 year. But Agri-Stability is a margin-based whole farm insurance program. It takes your allowable sales, so your calves, your grain, your hay, any of your farm products, and it takes off a few expenses, mostly things that are directly tied to those, so feed, forage, vet, med, fuel, chem, fert, seed, crop insurance. And then that builds your margin, compares your current year margin to either your last 3 years or your last 5-year average. And basically, if you get a 30% decline in margin, so not 30% drop in price or 30% drop in sales, it's a 30% drop in margin, which is very important. In your current year compared to that average, you could trigger a benefit. And Agri-Stability covers 80 cents on the dollar right now. So there's been a lot of very positive changes. I'll give a shout out to the folks in the room that have worked on that program. It's come back a long ways. It was very good. There were some changes that were kind of unpopular, and now it's quite good again. I would say maybe 75% of our clients are enrolled in Agri-Stability. A lot. It's very well used again in our small bubble anyway. So some things that can reduce the margin would be a drop in price of your commodities, a drop in production of your commodities, or an increase in prices of your inputs, or some combination of all of those things, which is the most likely scenario. So just really quick, the sample margin. So if you had a calf that sold for $3,000, you put $1,000 into it in feed, forage, vet, and med, that gives you about a $2,000 margin. So your coverage at 70%, so a 30% drop would take you down to $1,400. On the right-hand side, the sample where we might trigger an Agri-Stability payment, if the price of that calf dropped by 20%, so down to $2,400, our costs stayed the same, so we're not even showing an increase in cost there. Our margin's down to 1,400, and all of a sudden we've had a 30% drop in margin with just a 20% decrease in price. So I don't have to tell you guys about where we're at with high prices right now and what usually high prices are a cure for high prices. So someday we might see this 20% drop. So now is a good time to just sort of get ahead of that, in my opinion. Might not be able to see this graph very well, but the main point is on the far right hand side, we have high cost structures. So things that have high expenses. Those would be cattle feedlots, greenhouses, and then finishing hog barns. In the middle of the graph is our group 2s will be like your cow-calf operations and your dairies. And then group 1 will be the really low cost, like organic farms, apiaries, things that have a little less input. Basically what this is showing is the further right you are, so the closer you are to group 1, the higher cost you have to go into your operation, the less of a drop in margin you have to experience to get an agri-stability payment. So in some of these feedlots, it would be like a 10% drop in revenue could trigger a pretty gigantic agri-stability payment, and you probably are the expert on that, Roxanne. So if you have questions about that, Roxanne's the feedlot guru in our group. But just in the interest of time, we'll keep going. So why now? I mentioned the deadline's been extended to July 31st. So if you're not enrolled, you have lots of time still. Don't wait till July 31st, but you have time. And you also have the option to use 3 years for your reference margin to create that average we're comparing to instead of 5. And so 2024 was a great year. 23 was pretty good. And it looks like 2025 is shaping up to be a great year as well. So if you're thinking about it for next year even, you might as well enroll now, get protection for 2025, and your margin for 2026 is going to be outstandingly high compared to prior years. So first time enrollments, 3 years instead of 5. Obviously very high prices now, creating high margins, which is a good thing. If they go down, it's even easier to get a payment because our margins have been so high. A couple more things on agri-stability. Accurate record keeping. So some people get a little bit nervous about what it takes to get in the program. It takes only stuff you should already be doing. So track your inventory. Not even like to the decimal, but close enough that it's easy to follow. And if you do accrual financial statements with your accountant, you'll already be understanding of things like prepaids and deferrals and payables. So it's not that intimidating. It's very affordable. It's by far the cheapest insurance you can get for what the margin that you can get. And it does layer in with some other insurance programs. It interacts with other insurance programs, so you might want to run that past your accountant to see how things like crop insurance or rainfall insurance might affect it or not affect it. But livestock price insurance is one right now that you can actually double dip on. It does not cannibalize your agri-stability. And don't be afraid to pull in some professionals if it's intimidating. There's lots of good accounting firms that will help with agri-stability. Okay, one more really busy graph here. This is a calculator that MNP has called the Ag Risk Management Projector. I won't spend a lot of time on it, but Tyson is the guy to talk to if you guys have questions. Really, it's a really quick modeling tool to say, here's my plan for 2026 or 2025. What happens if prices drop by 20%? When does agri-stability kick in? And you can model that out with Tyson in a 1 hour meeting pretty easy. So last thing I just want to touch on, I guess I covered already, livestock price insurance is a good program with historically high prices. There's nice coverage. It does not erode your agri-stability, so you can, like I said, double dip if you're in both. And then the rainfall insurance program's been getting more and more popular. That one would cannibalize the agri-stability coverage a bit, but it still means you're getting paid from one program or the other, so it's not necessarily a negative thing. So we wrapped through that last part quick. Maybe just if you guys have questions on agri-stability or want to know more about the deadline and the enrollment, just come grab one of us. We'll be here at least till late afternoon for sure. I don't know if we have time for questions or not.
Oh yeah, we can field a few questions. Like we're cutting into your coffee break, but that's totally fine. Jeff's the boss, isn't he? So go ahead with your question. Oh, just a sec. She's gonna pop your mic.
There we go. Sorry, I'm going to cut into the coffee break just for a second. At some of the zone meetings, something that's come up around some of this planning is who your brand is registered to. This is a bit of a new development, something I wanted to highlight here today. If your brand is registered to dad and the father and son are farming together and dad passes away, those calves are subject to probate. Okay, so you can't get the revenue from those calves if you go to sell them if they have dad's brand. Okay, so if you're incorporated and the brand did not transfer to the corporation, those calves are then subject to probate as well. And so make sure you go look where your brand is registered. That's something for the folks doing the planning to put on your checklist, but it's also something here for people with a little bit of gray hair to check out, who owns the brand, where it's registered, and how are you branding those calves to make sure that you don't get into trouble in the event of a untimely death.
Great comment. Thanks, Jeff.